It is an astonishing morning. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Danny Berger. Katie Greifeld is off. Bloomberg Open Interest starts right now.
Coming up, Palantir's unstoppable rally remains intact thanks to AI's astonishing impact. And those robust results helping to fuel further gains for equities as the earnings parade continues. Plus, Wall Street's windfall bonuses are set to rise across most sectors of the finance industry as the market rebounds. Danny, what are you watching?
I'm watching some of the earnings we've gotten in, Matt. They continue to come fast and thick. Apollo among them this morning. They reported record earnings from fees in the second quarter. Shares up 3.5% on that, but they did see a drop in their wealth unit. Matt, what are you looking at?
Well, speaking of earnings, Palantir blew past estimates in the last quarter, raised guidance for the full year as AI fuels growth in the business. And you can see those shares on track to gain another 7% this morning. Dan Ives, Wedbush Global Head of Tech Research, spoke on Palantir in the last hour.
The reason it's the messy of AI, they are owning the use cases on the software side. And I think the street continues to underestimate where this growth is going. And I believe over the coming years, Palantir, it's going to be on that Mount Rushmore of tech. And that's why investors are recognizing it. And we believe, I think this is just the beginning of this AI revolution, and Palantir is the gold standard.
Let's get more on Palantir. We're joined now by Bloomberg Tech co-host Caroline Hyde. Caroline, just how astonishing are these earnings?
Well, they managed to vindicate an astonishing run-up in the stock. You showed the 1 year that's up, year-to-date, 100%. It's up 500% in the last 12 months. It's the best performing stock in the S&P 500, but it's also the most expensive. If you're looking at their sales forecast for next year, they're trading more than 70 times that in terms of valuation. So they needed to post this growth, and boy, was there growth. You're seeing $1 billion per quarter now. Only 3 years ago, you were getting $1 billion per year. So you're just seeing up and to the right in terms of demand. But it's full-fledged demand. It's not just from the US government. It's not just from US commercial. It's from more international growth as well. But really, you saw the US on fire, and you particularly started to see commercial adoption. Because, look, they're helping Amazon really understand their supply chain. They're helping integrate into AWS. They're getting into defense tech. They're getting into big old school companies that want to understand how they can fast track using generative AI. That's where the winning formula is coming from.
Yeah, if they rise 8% today, they're trading at 100 times sales.
Wild.
I mean, that's an insane valuation. Even if Dan is correct and we continue to underestimate their growth, they're still only going to sell for maybe $4.5 billion worth of stuff in the full year.
And that is why you're hearing Baird, why you're hearing Jeffries, why you're hearing analyst after analyst saying, we think this is great growth, but the valuation is uncomfortable. The fundamentals are getting out of whack. Yes, you can love this stock, but really you saw Alex Karp, the CEO, and he has a flavorful tongue from time to time, but he's really thanking the retail investor community. He's saying that's where they've seen ultimately institutional investors and the buy side and the sell side almost not catch up to what they think is this winning track. He's saying that they've been defanged in many ways. Some of the people who bet against him, actually only 2% of open float is now shorted. People have just fallen away from betting against the stock because they can't catch their breath. They're just racking up losses when you do bet against this growth.
Yeah, this is what the PayPal mafia sometimes is capable of. Caroline Hyde, thanks very much. Caroline, of course, is the co-host of Bloomberg Tech. You can catch that program. Kicks off at 11 a.m. every weekday. We mentioned, by the way, Apollo's record $61 billion in earnings last quarter. Danny showed you the shares at the top of the show. Let's get over to Sonali Basak, who covers Wall Street for us, and you may recognize her as my co-anchor at 10 o'clock for the breakdown. What's going on with Apollo?
Just incredible. Apollo has been down by more than 14% this year, and by the way, so have many of its rivals. Blue Owl down more than 15%. People have been worried about private equity, but here's the thing about Apollo. It's not really a private equity firm, it's more so a private credit firm, and their assets under management, more than 80% are in credit and have grown tremendously. In fact, net inflows overall look like they are coming in close to double what Wall Street was expecting. So a lot of money bought in. You mentioned the wealth channel a little earlier. It's still about $4 billion bought in there. So nothing to cry about when you do see assets climbing at that rate, and proving, by the way, that the diversification, this is not the Apollo where they're just lending on buyouts. If that were the case, that's what people were worried about. You're not seeing that kind of deal financing come back. What you're seeing is an Apollo that's focusing on asset-based lending, investment-grade credit, and gaining more from that CLO company that they had acquired as well, which is more closely tied to leverage loans, and you do see debt markets coming back in a significant way.
A lot of the story about private capital fundraising has been they're all leaning on wealth channels right now because they can't fundraise from traditional institutional investors. Does Apollo prove that's not the case, or are they the exception to the rule?
They're a different breed, right? Because you saw Blackstone come in with the longest standing business there, but Apollo a couple of years ago came in and hired hundreds of people very, very quickly, and therefore leaned in so fast. They're still having institutional money clearly come in, but yes, that wealth channel and that race to get wealth assets, it proves to work out a lot for Apollo because they've invested in that infrastructure, and they also own an insurance company, which Blackstone will not do. And so that's the difference, and they are still bringing in money that way.
Sonali, thank you very much. We will see you at 10 a.m. Now, let's turn to pharma. It's a tale of two companies. Pfizer, that's jumping in the pre-market. It raised its outlook, shares up 2.5%. Hims and Hers, though, down nearly 11%. Weak GLP-1 sales. Joining us now is Bloomberg health reporter Madison Moeller. Madison, great to see you. Let's start with Pfizer. Okay, the results are good, but it seemed like it was all down to cost cutting. So how sustainable is the trajectory from Pfizer from here on out?
Exactly. I think that this doesn't really ease questions about what the future of Pfizer is going forward, which has sort of been the story for the last couple of years after COVID. Investors are obviously relieved, I think, this morning that the cost cutting is helping, that they've implemented. But the story remains, what's next for Pfizer after COVID? I mean, they still have struggled to really bring a great new blockbuster product to market. They're sort of falling behind in the GLP-1 weight loss drug race. So the question remains, what are they going to do next? But for today, I think investors are relieved.
What's the story with Hims and Hers? Because I can't understand how you'd have a drop in GLP-1 sales. This sector is on fire. Is it a regulatory issue or a breakup in their partnership?
Exactly. So it comes down to a little bit of a regulatory issue. We saw in the last few months in February that the FDA said that compounding pharmacies and some of these firms that were selling knockoff, copycat versions of the drugs couldn't do that anymore because the brand name drug makers could supply enough of their drugs to meet demand. So that affected Hims, which was selling a cheaper copycat version of the drugs. And they had to pull back a little bit in terms of what dosages they were able to offer. And some of that switching over and just the, figuring out behind the scenes what their business looked like going forward is clearly affecting them, sort of dragging on sales. So again, the story for both companies is kind of what's next? What's the next big growth driver? They had a blockbuster product, and how do you sustain that going forward?
And the big what's next is tariffs. I'm kind of surprised some of these stocks aren't down more, with President Trump speaking on American media saying that at some point you could see tariff rates up to 150% or 250% for these pharmaceutical companies. What might we expect when it comes for these sectoral tariffs, and how are companies getting ready to deal with them?
By the way, Madison was on with us yesterday, and we were talking about how he wants to reduce drug prices by 1,500%. So how can he do that at the same time as he's putting 250% tariffs on pharma?
I mean, I think that that's exactly the question that companies are asking. I mean, they're all saying it's impossible to really forecast what the impact's going to be when we have no idea really what's going on. I mean, there are so many different levers that Trump has been planning to pull on pharma, between tariffs, most favored nation, all of this stuff. They don't really know what the impact's going to be yet. And there are lots of different numbers being thrown around, both on the tariff side and on the drug pricing side. So it's just another wait and see game of when is he actually going to do this? What is he actually going to do? What can he do? And we're all waiting to see what happens with that.
All right, Madison, thanks very much for joining us. Madison Miller there talking to us about healthcare. And I think we can give credit where credit is due. That interview with President Trump on CNBC was pretty amazing. I can't decide if Joe Kay was even better than Donald Trump. It was just entertaining television.
Yeah, I'm actually just not going to comment. I couldn't take my eyes away. That's about it.
Let's take a look at what's going on in the markets. Quick check on futures after the big gains that we saw yesterday. We're not seeing such huge moves, but still green arrows. S&P futures up 0.1%. The tech stocks doing a little better, gaining 0.25%, and Russell 2000 futures and small caps up about 1/3%.
Hey, which, by the way, we are now less than 1% away from all-time highs. So that's cool.
On the small caps.
For the S&P 500 too. So hey, we're getting there. Yeah. This probably not helping though. Caterpillar earnings, some of the moves on our radar, disappointing due to lower prices for its equipment and therefore smaller margins. We also saw Marriott second quarter earnings. Those beat expectations. Its global footprint made up for softening demand. And finally, Matt, I thought this was supposed to be recession-proof, but volumes were worse for selling beers, and they also had to deal with aluminum tariffs weighing on the business as well. So those shares down 1.7%.
Yeah, Molson Coors may have a bit of a Canada problem, and it looks like small caps still need to catch up a little bit more. 3% off the all-time high that I see on July 23rd. Coming up, AMD stock is outperforming NVIDIA this year. The chip giant reports earnings tonight with a focus on tariffs. What else? More on that next. This is Open Interest. Let's get to high interest, a look at what's making headlines around the world. Yum Brands is disappointing with revenue in the latest quarter. Slower growth at Taco Bell and KFC hampered results. Meanwhile, Pizza Hut posted a 7th straight quarter of same-store sales declines. The chain has struggled after the pandemic as U.S. diners look for cheaper eats, and frankly, the stores are pretty disappointing. Tesla is still posting steep sales declines in Europe, where the EV maker is losing significant share to China's BYD. Tesla's July sales fell by more than half in Germany and the UK. Meanwhile, BYD, the Chinese car maker, more than quadrupled registration in those countries. That's a huge story for Chinese competition. And NVIDIA's main server assembly partner, Han Hai, is reporting its slowest sales growth since January. Sales rose about 7%, while analysts were looking for a 12% increase in third quarter revenue. The results indicate that tariff-induced uncertainties are impacting electronics demands and prompt questions about growth at NVIDIA as well. Dan.
There might be questions, Matt, but ask the questions, trade on it later. NVIDIA is little changed this morning. Let's discuss that with Bloomberg Intelligence Global Head of Tech Research, Mandeep Singh. Mandeep, is there reason behind the lack of movement, or does this matter more?
Well, I mean, we know the first 6 months have been pretty solid, over 20% growth. So to me, there is a seasonal component to this July number, and it's hard to extrapolate, that means a deceleration in server growth, because all the CapEx guide that we have gathered this earnings season points to second half being strong, even 2026 first half being strong. So at least on the AI server side, there is nothing to suggest there is a tapering of demand. We know smartphones and other end markets have been weak. And so for a company of Han Hai's size, clearly they have exposure to all the end markets, and that softness remains. But AI servers, I don't think we should be extrapolating anything here.
All right, then I'll stop. I got to ask quickly about TSMC, because an hour ago, President Trump told Joe Kernan they're going to invest $300 billion to build a factory in Arizona. That would be an incredibly expensive factory. Does it really cost $300 billion to put up a chip fab?
Well, so when it comes to fabs, even, someone like Han Hai, which is putting assembly plants, we're talking about spending in excess of $50 billion. So I don't know exactly whether it's going to be the advanced node facility that's going to cost $300 billion. It does sound like a high number to me. With that being said, I mean, all these suppliers, when it comes to the suppliers that make NVIDIA chips or other types of chips, they are looking to expand in the U.S. I mean, that is certainly the case. It reflects in their CapEx guide. I still doubt, it's going to happen in the pace that the administration expects, because these plants take, 3 to 5 years to build. So clearly there is a longer roadmap. But, I mean, $300 billion does sound excessive.
Well, which, by the way, last time TSMC talked about investing in the U.S., they said $100 billion. So Trump just increased their commitment by threefold. So I'm sure TSMC likes that. We also heard from a U.S. official overnight, Mandeep, that the U.S. would try to track chips and where they're going, presumably to try to make sure that the most advanced chips doesn't end up in the hands of China. How would they even do this? Is this even possible?
Well, I mean, look, we can track location on our smartphones. So when it comes to chips, clearly the location tracking is possible. The thing that is hard to trace here is when it comes to compute, for training, we're talking about, compute clusters that are 50,000, 100,000 chips consumed on the cloud. So you don't actually know who the end consumer of those chips are because these are hosted on cloud. And that is what makes the traceability so hard. You can have location of the chips, but you still don't know who the end customer is. And from that perspective, the IP address can change. There are so many things that can be done in terms of spoofing who the actual end customer is. So I don't know if this is going to be the resolution to, solving the China problem and whether the Chinese LLM players are actually accessing the chips. But clearly, that's where it's going in terms of tracing, where those, the latest Blackwell chips are ending up in terms of consumer usage.
Well, NVIDIA stock is up 34% this year. That's nothing compared to Palantir's rally. But AMD is up 46%. So investors are expecting a lot from this company, which is reporting earnings after the bell. What do you expect from AMD?
So when I compare, NVIDIA kind of painting a quarter with 40 billion plus in revenue and AMD's AI revenue are still 1 billion, that just goes to show what kind of a market share AMD has. Now, what's happened this year is the market has shifted from training towards inferencing and reasoning. And that is where it's in Meta's best interest, Amazon and Google's best interest to lower their reliance on NVIDIA. And they want a second player to do well. So that's where I think everyone is excited about AMD's prospects. And also China market opening up actually helps AMD more than NVIDIA because right now, I think NVIDIA isn't doing as much business in China currently. So if the market opens up and Chinese companies want as much supply as they can of these advanced chips, then they'll take whatever AMD has to offer as well. So I do think there is potential upside from hyperscale internal workloads for AMD, as well as the China market opening up for both AMD, NVIDIA, and as well as Broadcom.
All right, well, those earnings are coming out after the bell, so I expect I'll see you in the radio studio with Carol Massar when those numbers cross. Mandeep Singh runs our tech coverage for us at Bloomberg Intelligence. Quick check on what's going on ahead of the opening bell in terms of futures. We're still seeing gains that are slight on the S&P, but remain around 0.1%. Tech gains a little bit better, and the small caps even better. I have to correct to some extent what I said about the Russell 2000 to Danny earlier because I wasn't looking at a broad enough picture of the index. I said the high that I saw was 3% away in July. In fact, if you zoom out a year, you'll see an even higher high in November of 2024. And if you zoom out 5 years, you'll see pretty much the same number, 2442 in 2021. So it's been a while since the Russell.
But you're just seeing into the future, because maybe if we get more than 2 cuts, like Mary Daly said, we'll get near 3% away from all-time highs, or maybe even more. So you weren't wrong. You were just
the timing is off. Thank you so much for that.
You're welcome. That's what I'm here for.
Coming up, Nancy Tengler talks upward earnings revisions in tech, data independence, and her outlook for the Fed. This is Bloomberg Open Interest.
Jeffries out with a note saying that the Fed could trigger a stock market regime change and big tech would lose out. Strategist Andrew Greenbaum says that value and small cap stocks tend to outperform mega cap stocks for multiple years when the Fed is reducing interest rates. That's based on data from the past 4 rate cutting cycles. It comes as investors still, though, have already piled into big tech like the Mag 7. Laffer Tengler CEO and CIO Nancy Tengler joins us now, who likes herself a bit of big tech. Nancy, really great to see you this morning. Yesterday, we had this rally. Maybe it was prompted by the idea that we're going to get cuts. And in it, the breadth was really wide in what rallied. Is that a taste of what is to come for this equity market and leadership if we do get Fed cuts, at least in some pace this year?
Yeah, well, hi, Danny. Yes, I think so. We've already seen the breadth widen out over the last year, and we have been increasing our exposure to other sectors and specifically names that we think are going to benefit in the new regime. But the notion, I mean, if you just look at value versus, and I'm a value manager, tried and true, trained that way 40 years ago, but there has been a regime change. And if you look at the underperformance of value relative to growth, it's been since 2007, and we've had rising interest rate environments and declining interest rate environments. I think you want to be where the growth is, and particularly in a decelerating economic environment. And I think what we learned from the job numbers and the PMIs and even GDP when averaged over 2 quarters is that the economy is fine, but it's not accelerating. And in that environment, you want to own the winners, the firms that can deliver reliable earnings growth. And the tech companies, these are not your 1990s internet companies, though I've drawn that analogy for the last 4 years. There are a lot of similarities. These are companies that have a lot of levers to pull and are growing in the 20+% range on hundreds of billions of dollars in revenue.
All right, Nancy, we're going to keep you with us because I want to talk about a lot of the stocks in your portfolio, particularly Palantir, which you've held for a while. Interesting for a value manager because of the insane valuation, but you've been right. And I also want to talk about that interest rate environment. Is it a rising rate environment? I would have thought that, but we're looking at rates that are holding pretty low. A check on futures ahead of the opening bell, which comes up in just 4 minutes' time. We're still looking at gains on the S&P. We had a big gain yesterday, almost made back all of what we lost on Friday. NASDAQ futures up 0.2%, and the small caps gaining a third. We're back into with the opening bell on the NASDAQ and the New York Stock Exchange. This is Bloomberg. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. This is one of those days when there's so much going on under the hood. We had a ton of earnings out after the bell yesterday, a ton before the bell today, a ton coming out later, and some big movements in those individual stock prices, but not a lot going on in futures. S&P futures up 0.1%. Okay, the tech futures are doing a little better, 0.2%, but we're pretty much flat from the big move on Friday. We lost 100 points on the S&P, and then we gained 90 points back yesterday. Maybe we'll claw ourselves all the way out of that NFP hole that we were in. Right now, you see Orion Properties ringing the bell on the New York Stock Exchange. A lot of dudes there. And Northwest Bank shares ringing the bell down at the NASDAQ market site. That's an interesting shot that they swapped over to. Apparently, that bank is from the great state of Ohio. It's not my Huntington Bank shares, but I still have a lot of respect for those Buckeyes.
We will still take it, Matt. Well, I'm looking at some of the stocks that are moving. Now that we've got the markets open, that reported earnings, Apollo being one of them, reporting record earnings from fees in the second quarter. It did see a drop in its wealth unit. That doesn't matter, though, because it still brought in a strong share of wealth, and there's been this narrative that only wealth was keeping private capital afloat. So Matt fights it. Shares are up 4.5%. Matt, no shade to Apollo, but you kind of have a much more exciting stock this morning.
Well, we had so much. Apollo was out, DuPont was out, Caterpillar was out, the biggest earth mover in the world. Yum Brands, my beloved KFC and Taco Bell, but nothing as exciting as Palantir. Absolutely blew past estimates last quarter, raised guidance for the full year, and the stock has been on fire and continues to burn here, up another 8%. This company is now worth $400 billion and change, even though they only expect sales of $4 billion this year. Let's get back to Nancy Tengler here, the CEO and CIO at Laffer Tengler. And you've had faith in this stock. You've been invested, Nancy, and you're getting paid for that. But these valuations must be terrifying.
Well, you said it's not really a typical stock for a value manager. We do also run a growth portfolio. Our value strategy owns things like Oracle, Microsoft, a little bit of Apple. So it's a growth at a reasonable price strategy. But yes, the valuation is nuts, as it often is when you have an emerging technology, a company that at least is posting earnings. But this is reminiscent of Amazon and back in the day, Tesla at one point, NVIDIA. And so what you have to look at is the total addressable market, obviously, and then the guidance you're getting from management. And it is impressive. They are in the early stages of their growth. And we think the opportunity for expansion is remarkable. And so this is one I think you don't necessarily have to chase it here, but you wait for pullbacks. I mean, it wasn't that long ago. The stock was last year, it was at $88 a share. So you will get opportunities just like we did with NVIDIA, Microsoft, Tesla during the tariff tantrum in March and April when we were in buying pretty aggressively, which is hard to do when you're facing that kind of negative sentiment and a market that was basically in a bear market. So this is when you put it away and you add to it on weakness because they are the emerging technology. And that's where you want to be for the next 3 to 5, even 10 years.
Nancy, do you put stock in any company that touches the PayPal mafia? Because, you know, you have from Elon Musk, who spent $250 million to get President Trump reelected, to Peter Thiel, who essentially made J.D. Vance. Like, these guys are the captains of industry. They're the J.P. Morgans of today on the left coast.
Yeah, and Alex Karp, let's not forget. Yeah, I mean, I think what you have is a group of people who are much more libertarian than they are left or right, and that is pretty clear from reading, you know, Musk's biography, Karp's book. There is an emergence of keep your hands off my stuff, and let me do what, you know, let me grow my business, and that's what you're getting. But yeah, I mean, it was an interesting confluence of brilliant minds, independent spirits, and I think we're going to continue to see the benefits of that.
And some CEOs that like to be outspoken, just worth reading what CEO Alex Karp said after the Palantir earnings. The skeptics are admittedly fewer now, having been defanged and bent into a kind of submission. I don't know how I feel about a metaphor that includes violence, Nancy. But you could maybe extend that to kind of everything tech and everything this market. We have been defanged and bent into submission if you are a bear. How difficult is it to fight the gains from here?
Yeah, that is a great quote and well said. Yeah, I mean, it is the Wild West, let's be clear, but they are delivering technologies that are much more than just eyeballs on a website. And that was the 90s euphoria. These are real businesses with fortress balance sheets. So I don't think you want to fight this. I mean, if you have a Microsoft with earnings up 24% year over year on a massive revenue base, plus revenue growth of 18%, for example, and that's in our TGLR ETF, which is our value strategy. This is, in fact, a time when you want to go along for the ride. And I've made the mistake of being a knee-jerk value manager, which is it goes down, you buy more. But I don't want to be anywhere near staples in this environment. I want to own the drivers of the economy, and that is technology now and probably for a number of years into the future.
Hey, yesterday I was talking with Bill Smead. He was out in Portland to escape the dry 120-degree heat of Phoenix. And, he was comparing the market now, the narrow leadership, the concentration in this market to the stock market of 1987, which always, makes me look up. What do you think about the fact that we just can't get to any breadth? The Mag 7 companies have 26% earnings growth, and the rest of the S&P 493 only has 4%.
Yeah, no, that is, I've heard that analogy multiple times, and it's usually from the deep value guys. And by the way, I'm in Tahoe escaping the melting in Scottsdale. So good for him that he got out of it. But I do think you want to, again, if you go back and look at breadth, it was you know, in the 70s or in the 90s, it was the Four Horsemen. In the 70s, it was a small group of names that drove the market, 3 or 4 or 5. And that's typical of a market top. But this is much broader. And we talked about it at the start of the segment. This is a broader rally. It's not just semis, it's software. It's not just technology, it's infrastructure names. Now, the growth may be significantly less in those names, but they're still growing and they're part of a sustainable growth environment. And so that's where we're turning our attention. And we're adding to names like Deere, which is using AI to drive autonomous tractors. I mean, think of it. And Walmart, that's using all the technologies to improve their margins, and they've demonstrated that through a dividend growth of 8 to 9 to 10% after years of 1 to 2. So it's the old economy companies that are using the technologies to their advantage, and then the technology companies that are driving the growth. And I don't see that analogy. I was managing money then. It was a different environment, and there were all sorts of other elements. Check out the productivity. With this overstatement in jobs that we've seen, and then the revisions down, that means that productivity was much better than we thought. Remember, last year it was May to May, $650,000 job overstatement. Friday, we got the last couple of months revision. It was 258,000 job overstatement. This is, in fact, an environment where productivity is going to drive lower inflation. Now in the 90s, we had 3%, so we can sustain that, but lower inflationary growth. And that to me is a once in a generation opportunity.
All right, Nancy, you are a wealth of knowledge and you're winning in these markets. So really great to talk to you. Nancy Tengler, they're the CEO and CIO at Laffer Tengler. Let's take a look at what's going on the benchmark index. This is the move screen. I think it's the most dynamic way to look at this index because you can see the breadth here, 327 stocks trading up, 173 trading down. You can see this market continues to climb higher. It opened at 63.36. Right now we're at 63.42. The winners, as you would expect, are these big tech companies, as we were just talking about. Amazon right now adding almost 5 points to the S&P. Palantir itself adding 3 points. And by the way, that's really impressive because it's a much smaller stock, right? Only a $400 billion market cap compared to $2 trillion market cap. Google right now adding a point. Broadcom up there, maybe should be the Mag 8. And you can see that really tech ruling the roost here. In terms of the downside, Vertex Pharmaceuticals, Apple, the big tech stock left out, maybe swap out Apple for Broadcom, also taking some points off of the S&P right now. And you do see some of those pharma stocks down. Eli Lilly, for example. Maybe investors were listening or watching on CNBC when President Trump said he could raise pharma tariffs up to 250%, Danny.
Yeah, painful. Painful for the banks, too, with Trump saying that he was debanked from J.P. Morgan. So who knew that could be in his sights, too. OK, coming up on the show, more homeowners are turning to subscription-based platforms for repairs and maintenance. We're going to discuss the trends with the CEO of one of the biggest of the services. That's Frontdoor. That's coming up next on Bloomberg Open Interest. Time now for some top calls, some of the analyst action that we are focusing on this morning. First up, Wayfair. That's getting raised to a buy at Citi. The firm says that the impacts from tariffs have been milder than expected. Shares up nearly 3%. Next up, Akamai getting a cut to a sale at Morgan Stanley. The analysts there say that the cloud company facing a number of near-term challenges. They also see limited opportunities in the next year. Those shares down 1 1/3. Finally, Wall Street weighing in on Palantir's robust earnings report. Deutsche Bank says that it's raising its recommendation on the stock, but a little bit of caution there from the analyst. Jeffries says that the company's valuation is on a different planet. RBC says the stock is stretching the multiple. Matt, I think its earnings multiple is something, forward earnings multiple at least, is something like 280. Literally any way you slice it, it is insane.
Yeah, it's nuts. 100 times sales, because right now the market cap is $414 billion, and they projected sales for the full year 4.14 to 4.15. It is unique on the benchmark index. There is no company that approaches that. Even NVIDIA only trades at like 30 times sales. So really fascinating stuff. Let's pivot to home services, because on-demand home services platform Frontdoor just raised its full-year outlook as more homeowners rely on the subscription service for repairs and renovations. The company has more than 2 million customers nationwide, and the CEO, Bill Cobb, joins us now. Bill, great to have you on the program. A lot of talk in our editorial meeting this morning about what you guys do. You essentially offer service contracts, if I understand it correctly, like you would get for a car or a motorcycle, but for your home. Tell us more about the business.
Hi, Matt. Thanks for having me. Yeah, what we do, we provide repair and replacement opportunities for about 27 systems and appliances in the home. They cover, it's a yearly subscription fee. And we're there to, as people stay in their home more, because, home sales have been stagnant. People are staying in their homes more, and they're looking for a service like ours. And so we've been fortunate in that regard. So we have both a real estate business and a direct-to-consumer, and what we call a renewals business, where people stay with us. And so that's what we do all the time. Is we have contractors who go into people's homes and repair appliances, HVAC equipment, et cetera.
So, Bill, help me understand how you staff, this demand, because I try and get plumbers. I try and get electricians. It's very difficult. And that was before these mass deportations. Now that we're sending, millions of people who typically work in those kind of jobs out of this country, how do you get an HVAC guy to me if my air conditioner breaks down in the middle of August?
I think that's one of the advantages we bring. We have 16,000 contractors we have on our service. We have what we call 4,000 preferred contractors. So what they do is they focus on, answering the calls that you're talking about. So we have a service. You sign up with us. We provide the contractors. You go through our system, and we come out and repair, as you said, an HVAC in the middle of the summer.
Some of these things, Bill, I think about refrigerators, washing machines. They're going to be the first that you really start to see some of the tariff impact come in. It's what we saw last time around in Trump 1.0. Your customers, are you seeing them behave any differently in anticipation of higher costs for new products?
Not yet. We've seen very little impact from tariffs, a little bit in appliances, to your point. But for the most part, we have seen very little from tariffs. I think what really is affecting our business so far in a very good way is that as people stay in their home longer, systems are going to break. You're going to need, your HVAC's going to go, your appliances are going to go. So they sign up with us to guard against that. And I think that we've been fortunate, and we've provided really good service. Our retention rate is close to 80% of what we call our renewals. And that's the backbone of our business, while at the same time, we're very aggressive at finding first-year customers.
I got to say that you sound optimistic, and investors like the story, Bill, but I'm looking at an air mover that costs $5,000 now. I can't imagine what it costs after tariffs, and I'm still wondering about, the labor drop that we saw for foreign-born workers in the non-farm payrolls number on Friday. Aren't these headwinds, or aren't they difficult to get this equipment and these workers?
So we haven't had an issue with supply chain at this point. Excuse me. Workers, we've been fortunate. Our contractors have stayed pretty strong in terms of keeping their workers. So again, all of our contractors are bonded. Their workers are bonded. They're technically proficient. So we've been fortunate, and I think that's one of the advantages we bring, that we have a steady, stable group of contractors who do the work for us.
All right, Bill, we're going to have to leave it there. Thank you so much for your time this morning. That was the Frontdoor CEO, Bill Cobb, out with earnings this morning. Shares are weaker, but they did report a rise in their revenue and full-year guidance. Okay, coming up, a bonus boost for Wall Street. We're going to have the details for you next. Maybe a little bit of the banking story with Donald Trump saying that he was kicked out of J.P. Morgan. All that's coming up. This is Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check of what's going on in stocks and the broader index level. You're not seeing a heck of a lot of movement. Right now, we're up 0.2% on the S&P 500, even though we've had earnings from a gazillion companies. After the bell last night, we got Palantir, we got Hims and Hers. Today we got DuPont, we got Caterpillar. I mean, you're going to see them. We got a ton. Tech stocks doing a little bit better, up about 1/3% right now. Take a look at some of the movers here. NVIDIA actually down a little bit. Maybe investors are reading through that data that their server supplier Han Hai had a slowdown in sales. Palantir just powering higher, up 9%, worth like $415 billion now. Caterpillar disappointing on the earnings front, down just 0.4%. Pfizer gaining 0.4, even though President Trump says he wants to raise pharma tariffs eventually to 250%. And then JP Morgan Chase and Apollo, a couple of financial companies. Apollo killing it on the earnings front. But we want to stay on Wall Street, Danny, to talk a little bit about Wall Street bonuses.
Yeah, we do, because they had such a robust earnings season, right? And falling in from that, bonuses are set to rise across most of the sectors of the finance industry with a rebounding market. Bloomberg finance reporter Catherine Doherty joins us now with the details. I mean, you'd hope so, right? After the earnings that they had, you have to reward the workers.
Yes, and it's not across the board. There's definitely parts of the banking industry that are outperforming their peers. So specifically trading and equity traders are seeing a boom, and that's just because of the volatility that has continued through the second quarter, and we're expected to end on a pretty high note of the year. This is a stark contrast to how the beginning of this year started, where we were seeing some bumps, there was volatility, but there was a huge question mark on how the market was going to sustain that momentum continuing through the year. We've now seen that. The expectation is we'll end for the traders seeing some payouts as high as 30% is what this report is alluding to. But then there's also in investment banking, smaller payouts, flat to up 5%. And within that group, there's winners and losers. So you have equity underwriting still lower than debt underwriting, but advisory, a surprise kind of tick up. And that is really connected to what we saw in the second quarter from the U.S. banks. They're saying that not only do they see these green shoots start to kind of continue, and that they expect that the momentum will actually pick up in the second half of the year. So we actually see some of the advisory fees coming through, and that means that the advisory and M&A bankers will see higher payouts than what we expected at the beginning of this year.
It's a great story, and there's a fantastic breakdown of who's doing well and who isn't doing quite as well. I see retail banking flat to down 5%, retail and commercial banking. And I think about Donald Trump's comments on CNBC this morning that he may do something to regulate banks that he doesn't think treat conservatives, or rather Trump supporters, as well as they should. He was complaining himself about his treatment at the hands of Jamie Dimon, his treatment at the hands of Brian Moynihan. What do we know about the president's plans?
So you bring up regulation. This is actually something that the president himself is acknowledging, and that the bank industry has pointed as the main problem for this topic of debanking. They have said the reason that they're shutting down customers' accounts is because they have pressure from various forms of regulation. They have these 3 regulators that are looking after them to shut down accounts, whether it's because of reputational risk or other factors that they say is pressuring them to do this. And so the president is also acknowledging that the regulators, he's calling out the previous administration for putting on pressure to the U.S. banks. What we're going to see next is there's reports of this executive order coming out that would essentially, we would do 2 things. It would have the banks look at the process for which they have to evaluate whether or not they're shutting down a customer account. And then for the regulators, they're going to have to reevaluate. So it's actually not additional regulation. We might see a pull back. There's going to just have to be a reevaluation to prevent something like this happening in the future.
All right, Cato, thanks so much for joining us. Catherine Doherty covers the banks for us. To wrap that up, we've got big bonuses coming out, especially if you're an equities trader, up to 30%, 10 to 20% for fixed income trader, 5% for investment bankers. Cameron Dawson coming up next, Avi Mehrotra, as well as Kevin Kopelman. This is Bloomberg. We are 30 minutes into the trading day, still looking at slight gains here. To me, the most interesting thing of the last couple of trading sessions is the 10-year yield, and bond yields across the board have just been holding steady even as the equity market has rebounded from Friday's drop.
It has been interesting, and usually I'm the one watching the bond market. I'm going to flip gears here and watch the stock market because we are less than 60 points away from that all-time high that we've been talking about. This is a market that misses 6,400, Matt.
All right, welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Sonali Basak. We're looking at some breaking economic data crossing the wire here. July ISM services data. We are going to bring in Michael McKee, Bloomberg's international economics and policy correspondent. Mike, what are you looking at?
Well, we're looking at a kind of disappointing number. We're still seeing expansion in services at 50.1, but that's down from 50.8 in the month of June, and it's certainly well below the 51.5 that people anticipated, economists anticipated. Prices paid rises, though, 69.9 from 67.5. And remember, these are service industry prices, so these aren't affected by tariffs. But it is possible that if we're seeing goods prices go up and other prices go up, that service industries are raising prices as well. Production for the month comes in at 52.6. That's down from 54.2 the month before. New orders are down as well, 50.3 from 51.3. The employment number, a week ago, we would have helped to know this, but it was 46.4, well below the 47.2 of the month before in June. And then when you look at inventories, 51.8 from 52.7. Everything is kind of down. The backlog of orders has risen, 44.3 from 42.4. And new export orders falls below 50, 47.9 from 51.1. So it does look like service industry business has slowed along with everything else out there. The only thing we can tell you is that the services PMI from the S&P folks was at 55.7 from 55.2. Now, they represent generally smaller companies than what the ISM does. But so there's still some expansion going on out there. It's just a question of how much and if the trend is going in the wrong direction.
I also just want to point out, look at that move in the 2-year. It's reversing some of it. It was higher this morning, now down a little more, still higher on the day, but we've erased a lot of that jump in the yield. How often are you seeing the market really, you have the S&P erasing a lot of its opening gains right now? You don't like it?
Well, there's no movement at all.
The point that I'm trying to make
the S&P
here,
has moved like 6 points today. So I know what you're trying to do. You're trying to drum up the drama, and I love it.
Sensitive
but there isn't
every
any
piece of economic data.
I mean, it is a little bit of a disappointment, Mike McKee, and I wonder if the head of the ISM has to fear for his job.
Well, fortunately for him, the ISM is a separate private organization, and the president doesn't have any authority to fire him. I mean, nobody's probably told
that
Donald
can't
Trump
stop
he can't.
him.
Yeah, that won't stop him.
And the Supreme Court will allow it.
But the numbers just continue to show that maybe the bond market thinks we're going to get a rate cut.
All right, Michael McKee, our international policy and economics correspondent. Let's bring in Cameron Dawson right now, Chief Investment Officer at Newedge Wealth. And I'm going to stick on this fixed income theme for a minute because, so I sit next to Sonali. We're obsessed with rates.
A few basis points makes me crazy because the basis trade is levered.
Right. I mean, but compared to Friday, this is zero move. Nonetheless, I thought we were in an increasing rate environment, right? The baby boomers are done saving. The Chinese are not buying our treasuries, nor is the rest of the world, right? The risk premium has to be higher because we fire statisticians when we don't like the numbers, and we try and control the Fed. So why are we at 420 on the 10-year?
It depends on where you're looking at the yield curve. If you're looking at the 2-year, you're in a downtrend. The 2-year's expecting rate cuts. If you look at the 10-year, you are flatlined. You've effectively seen your 200-day moving average go sideways for the last 18 months, so there's not much of a message there. But the 30-year is pricing in some of those risks that you're capturing, which is that you're in this uptrend. And it's not just in the U.S. You see it in German bunds. You see it in Japanese JGBs, that you have this uptrend in the long end of the yield curve that suggests that people are concerned about holding duration. They're concerned about fiscal dominance. They're concerned about sticky inflation. And that's where you're seeing those risks get priced in.
This is what you've done to me, Sonali.
It
You've molded
took a few
me.
months, but I'm thrilled to hear it. Anyways, I do react strongly to the basis points moves lower in the 2-year because where's the bias? Even if you think that the bias is lower on the 2-year, there's a concern here that you're not going to get as many rate cuts as you would expect into next year because of that inflation undertone.
Well, I think that if you look at what has been priced in for the Fed, there has been some pushing back of when they would begin their rate cuts, but then those got pulled right on forward with last week's really weak job print. So the 2-year remains in this cutting bias because there's this expectation that kind of no matter what the economic scenario, once you get a new head of the Fed in, that there will be cuts being delivered. And the only scenario where maybe cuts aren't delivered is some huge reacceleration in inflation, but I don't think that that's on anybody's bingo card at this point.
Yeah, inflation looks like it's coming down. Unemployment, I mean, if you just look at the headline numbers, right? Unemployment, 4.1, 4.2%. The S&P 500, 6,400. I mean, rates, the 10-year 420, everything looks fantastic, doesn't it?
Well, if you look at financial conditions, they remain very easy and in that stimulative territory, which causes you to raise a question of what would happen if the Fed were to cut 100 basis points,
Why would
200
they
basis
cut?
points. Well, if there's some kind of political capture that they deliver those cuts in order to appease certain demands and also to get funding costs lower, but it then raises the question of what is the unintended consequence of that. If you go back to a year like 1998, when the Fed cut 3 times in the midst of the LTCM crisis, you were in a huge bull market. The NASDAQ had hit a new high by the time the Fed delivered the 3rd cut, and then you went absolutely parabolic. So I think the risk is actually an upside bubble risk if you are cutting rates too much, if financial conditions are already too
That's
easy.
an inflation risk too, right?
Yeah. I think that would be the issue, is that you could see a resurgence of inflation. And then we go back to the 70s with this stop-start kind of Fed policy where they cut rates because they think that inflation's dead, and then inflation comes back and rears its head. And so you're in an environment today with inflation data where you're seeing it get a little spicy on the goods line because of what's going on with tariffs. But you have this downtrend in services because of the lagging housing or shelter inflation, which is causing inflation to remain, I think, more subdued than it would be if you didn't have that sort of slow-moving driver.
Spicy data, I love it. I want to pull up the Mag 7 on the year because really interesting to me is if you have a market that is still being dragged higher by those large tech names, the Mag 7 shows you that you're not feeling the love everywhere, and actually the year's worth of data tracks what you're seeing today. The NASDAQ is being driven higher by the likes of Palantir, not necessarily the broader Mag 7 right now. So per se, actually NVIDIA today is down 0.5%. What flips this around? Should investors be thinking differently about the Mag 7? Should there be a new kind of star index to be tracking those big names?
Yeah, well, I think that it comes down to something rather simple. It's like Carville said, it's the economy, stupid. It's all about earnings, which is that if earnings are being revised higher for a select cohort of names, that's where the market leadership goes. That has been Mag 7 over the course of the last 2 years. It's why equal weight S&P 500 is at year-to-date relative lows. So all of this hope and dream about a broadening out, because earnings remain so narrow, you aren't seeing the leadership broaden out in a more meaningful way because you just are still seeing those earnings revisions lower for the average stock.
Cameron, good to see you here on set. I was waiting to see you.
Because I have a million more questions, but sadly we don't have time.
Come back to join us. That is Cameron Dawson, Newedge Wealth Chief Investment Officer. Complicated market out there, but we're going to get a look at some single stocks moving this hour as well. We've been talking about it all morning. Palantir reporting a 48% increase in revenue for the 2nd quarter. Meanwhile, Caterpillar missed estimates here as the cost of tariffs slightly eroded margins. You're looking at Caterpillar down about 0.3%. Palantir, after the gain that we've seen in the last year, stunning to see it rise another 8%, Matt.
Yeah, absolutely stunning, adding $40 billion in market cap overnight. Pfizer raised its profit forecast for the year due to cost cuts, and it's up 3.5% in the face of what could be 250% tariffs on pharma.
I think that's incredible, and it shows you perhaps just how much these pharma companies have already been hit going into this moment. But Pfizer, we know it's needed some good news. Now is the moment. Anyways.
Coming up, Leon Capital continues to pump capital into real estate as it deploys its anti-private equity philosophy. We'll speak to Fernando de Leon, Leon Capital Group founder and CEO. Next, this is Bloomberg Open Interest. Let's get now to high interest to look at what's making headlines around the world. Texas Governor Greg Abbott ordered the arrest of Democratic lawmakers who left the state in an effort to block a controversial vote on new congressional maps. The redistricting push in Texas is part of a broader effort by the GOP to keep control of the House and cushion losses elsewhere in the country. The arrest warrants don't carry any criminal charges and can't be enforced across state lines, though. New York City voters will choose their next mayor in just over 90 days. Mayoral candidate and former New York Governor Andrew Cuomo joined Bloomberg Radio last hour to talk about why he sees frontrunner Zoran Mamdani as a threat to the city.
The existential threat is, I think, Assemblyman Mamdani as mayor of New York. And many Democratic leaders feel that, the business community feels that, people feel that. This is a radical form of socialism, economic socialism in New York City, which is the heart of business and corporate America.
Michael Bloomberg, who has, by the way, endorsed Cuomo, is founder and majority owner of Bloomberg LP, the parent company of Bloomberg TV and Radio. Apollo is reporting record earnings driven largely by fees. The firm collected $61 billion in the second quarter. Profit from fees reached a record $627 million, and the results are being driven by a boost in lending activity and a bump in managed assets. Sonali?
And as Apollo draws record earnings, another big investor is saying that the anti-private equity approach is what might work a little better. Fernando de Leon, founder and CEO of Leon Capital Group, joins us now for a Bloomberg exclusive. And this seems to be very popular, this idea of not needing to turn over assets as quickly, because the private equity industry, as we've been talking about so much on this show, has been saddled with assets that they have not been able to sell, and investors are getting frustrated. So how are you doing it differently?
Yeah, well, I think, look, I think we've seen in the private markets like maximum price efficiency. Sometimes even more than the public markets, you see private assets that trade at very high multiples. So we've decided to build businesses from the ground up. We have to manufacture assets, whether they're real estate assets or private companies, we have to manufacture them. And what I mean by that is we have to build them from the ground up and scale them and then hold them for the long term. And it's just a different version of creating long-term value. But it's, we see that assets get really, really pricey in private markets when they're bid up by, I think there's about 5,000 private equity funds today. And so we're seeing maximum price efficiency in those private markets.
So interesting, of the assets that you already own, how is it being impacted by the tariff story? We have a lot of debate, too, that we see from investors that believe, okay, maybe the worst is over. There are others who say that it's not being accounted for yet how bad things can get in terms of the ultimate rate.
Look, across our businesses, we operate directly about a dozen different businesses in healthcare, in real estate, and in financial services. So in some businesses like real estate, we own industrial and logistics distribution centers. We see tariffs impacting in a positive way. So we see reshoring from abroad. We see inventory buildup. We see some of our tenants calling and saying, hey, I need more space to hold inventory, to hold it in that warehouse because they want to control raw materials. And some of that is the supply chain. And some of it is tariffs, but some of it goes back to COVID, where they said, look, we can't be beholden to shipping from abroad. We've got to hold raw materials and inputs in our warehouses. So companies that want to control their supply chain are holding more inventory, and we see that every day where tenants call us and say, we need more space. So I think tariffs there have been sort of a positive in industrial and distribution logistics business. In other sectors where we operate, like insurance or healthcare services, I haven't seen a substantial impact from tariffs yet.
What about the positive effect of, Texas has been so attractive to capital, and we talk sometimes on this show about Y'all Street, right? We had Ari Rastegar, another property investor out of Austin, on the program a couple weeks ago. Listen to what he had to say about Texas.
Clearly, Texas has shown, its resilience and its business-friendly capabilities. I think more so than any state in the United States. I'm not biased, clearly, but now to be able to actually go public and access the global markets, now you're talking about something that's truly once in a generation.
He may be slightly biased, but do you agree that the attractiveness is just increasing on almost exponential level?
Well, yeah, and I think the reason I think it's happening is there's a human talent acquisition sort of tipping point, right? Where Dallas-Fort Worth, for instance, has created several 100,000 jobs in financial services. So you see Charles Schwab, Fidelity, Goldman Sachs just announced a very, very large presence there. So you see financial services in Dallas-Fort Worth. You see tech in Austin, so massive companies like Oracle and Apple that have built tremendous infrastructure there. So when we're hiring people, we can always hire in Dallas and Austin. Houston, people know it as sort of an energy capital, but it's really the largest medical center in the world, right? MD Anderson is a hub for massive medical and biosciences. So when we look at those markets, you have this massive talent pool, and when we're building and scaling businesses directly, that's a great tipping point, right? We employ about 7,000 people. We have to hire another 1,000 people in all of our businesses every year, and Texas is a great pool of human resource.
Does it make it difficult that it's so politicized? I mean, more than almost any other state in the nation, like California, Florida, Texas, right? Florida. You have your governor wants to arrest legislators. Like, that doesn't make business easy, does it?
Look, I'm a business person. I'm focused on creating jobs. I think our political leaders need to be focused on creating jobs as well, and that's really all I'm intent on doing.
On the job front, something we talk about a lot also on this program is that investor move into data centers. The reason I ask this is because, speaking of jobs, if you have a country that is essentially just full of data centers being built, and think about it, if AI is going to take over certain jobs and real estate is being allocated to data centers instead, is it creating jobs at the end of the day?
Look, the data center business today, I believe will continue to be held by public corporations, asset managers, which are mostly publicly traded vehicles now, and the hyperscalers. And I think they're going to deploy massive amounts of capital. I think the limiting factor for them is going to be energy and power. I think there's land availability in the Mid-Atlantic and Texas. We certainly see a lot of development, but I think energy is the limiting factor for them. So the way we've played that vertical is really to sell land to the hyperscalers, and most of the time it's been because it has ready access to a large power source.
Expand on the anti-private equity philosophy. And by the way, I'm sure a lot of people share your views, right? A lot of people work in industries where private equity has hurt more than helped. But how did you develop this, and what does it mean for your strategy?
Look, I think there are a lot of financial transactions in America that are one-way call options, right? There's no alignment to the outcome, and I think you've seen businesses that are massive fee revenue businesses today. Most of the assets for private equity, at least for the publics, comes from insurance assets, right? Apollo announced today, and most of their assets come from insurance. So there's a circularity to the capital flow that is interesting and complex and difficult to discern.
Continuation vehicles.
You see this very different financial engineering and complexity and circularity of the supply chain of money, of capital. So what we have simply said is we want to own businesses directly. We want to be the largest shareholder and the biggest owner of a business. And so if we own, for instance, we own one of the largest med spa businesses in the country, and we own it directly with a handful of partners that own parts of it. We own a mental health business that is a very sizable business and very fast growing. The assets that we own in real estate, we are always the largest investor in everything we do. We build businesses from the ground up, and so we create value. And then we have no timeline to say, hey, we've got to sell this by year 4 or 5. So it's just a different way of doing it. It's a different way of creating value for the long haul.
Fernando, Leon of Leon Capital Group. We thank you so much for joining us here on set. I do want to get a check on markets because we are seeing a turnaround story. And if you were watching the direction of travel a little earlier, you would have seen that the markets had been split coming into the trade. You have the S&P 500 now down about 0.2%. You have the NASDAQ pretty much flat, but if you look at the gainers here, Palantir on a points basis is leading the way. 2/3 of the index is in the red. The 10-year at 422, super interesting. But of course, it's that economic data at the top of the hour that started to break the straw on the camel's back. I don't know my idioms that.
The last straw.
Right?
That breaks the camel's back, yeah.
Right? That was something like that.
That's a good one.
Anyways.
Great. All right, Sonali and I will do more work on that during the break, and we'll be right back with more on open interest.
Let's get a check on the stock market right now because we're looking at an S&P 500 that has reversed. We are lower now on the morning, and the S&P 500 down about 0.2%. Very sorry. You have Palantir still leading on the upside on a points basis. No surprise there, but the move has been quickening. It's now up more than 9%. Amazon, Alphabet, Apple, all higher on the morning. Even Berkshire now gaining. But you do have Nvidia down almost 1%. One of their bigger partners showed some slowdown there. And of course, that's spooking investors just a little bit. Of course, Nvidia is the giant in the room, but it is dragging the S&P lower. But you too have Visa, JP Morgan lower on the day. Bank of America, remember the president's comments about the banking industry probably not helping them much this morning, but we're going to go for some of the things today that are helping the banking sector out a lot. We're going to talk about M&A next. Goldman Sachs believes that we're in the middle of a multi-year recovery and mergers. We're going to speak to the co-head of America's M&A next. This is Open Interest. Now, Goldman Sachs' bankers believe we're in year 2 of a multi-year M&A recovery, and Avi Mehrotra thinks that we have another 4 to 5 years to go. He joins us now. Avi, it's really interesting because you look at the kinds of deals we've seen, and recently we've seen a massive rush. Now, the cynics could say that this is because you want to front-run any potential future issues in the economy, but the people who are more optimistic say we're just getting started. What is the evidence of that?
So I think the way I think about this is that we're still in the very early innings, and I think there's a good foundation for deal activity to move forward from here. And what I mean about that is that we're seeing activity in all geographies across the world. We're seeing it in multiple industry sectors. We've seen participation by private equity, but I don't think we're anywhere near the potential that private equity has to participate in this M&A recovery. And so because of that, I think we're in the early stages. I think it's got some room to run. We think it's year 2, and we think it's got at least another 4 to 5 to go. But I would say that, some of this is going to be set by the tone of what happens on a policy basis and what happens with the macroeconomic data, which, continues to come in, somewhat mixed.
It's interesting. I want to pull up a chart in a moment here on the deals that we've seen in history that have been over $100 billion. There are not that many of them. But if you look at the deals that we're seeing this year, they're inching higher and higher. The Union Pacific Norfolk Southern deal could be anywhere between 70 and 90 billion, depending on how you value the equity on any given day.
Absolutely.
Are we going to see a $100 billion deal again anytime soon?
Well, I would say that the ambitions are running high. I think the C-suite feels that they can get things done in this moment that perhaps they couldn't a few years ago. And we're also living in a world of multi-trillion-dollar market cap companies. And so I do see, deals inching higher. Whether we cross 100 billion or not, remains to be seen. Some of the largest and most aggressive deals tend to happen late in the cycle, right? And so right now we're early in the cycle. I think there's a different type of deal that takes place right now. But look, as I was talking about private equity earlier, they are, very much risk on. And I think that if they start getting more aggressive, if corporates start getting more aggressive, if we start seeing more competition for assets, which we've already seen some of, I think all of those can, push deal volumes higher.
Vodafone Mannesmann was the first deal I worked on as a reporter. Obviously, the end of the internet bubble cycle. And do you see any other parallels between, the current AI cycle and the internet bubble of the late 90s, early 2000s?
So, I would say that when we saw the internet bubble, it was really somewhat of a phenomenon unto itself. It hadn't affected all sorts of companies and all sorts of industry sectors. What's different about AI this time around is that its impact across industries is quite pervasive. And so we're seeing deal flow happen because of the anticipation of AI. I think we're seeing companies think about the amount of capital they could deploy into R&D and CapEx versus M&A because of AI. And so I think it's impacting industries in a very broad-based manner that we really haven't seen before. I think this is somewhat unique.
I mean, CapEx is going to be trillions of dollars over just the span of a few years. Aren't you going to see a lot of money going towards M&A? Like we talk about all the time, Dan Ives says Apple needs to buy Perplexity. I'm not asking you to comment on a specific deal, obviously, but are we going to start to see that kind of movement?
I think anytime there's disruption and pressure on these industries, the way we've seen through AI, and the potential productivity gains that AI can bring to the table, I think that people are going to think very expansively. Part of, I think, what we're seeing right now is in-industry mergers that are really based on getting to scale, finding synergies, sustaining a competitive advantage either that you have already or coming to a new one. But I think as we get later in the cycle, those sorts of ambitions, I think, could bleed out into some of the things that you're talking about.
So what do you think about the technology industry's other capital use? Because the acqui-hires have been incredible. And if you are one of these large hyperscalers, why buy, right? Why not
What is acqui-hires?
Those massive $100 million pay packages, $200 million to carve out these teams. Why not just hire a bunch of people and use your money that way rather than trying to chase a Figma, for example, in terms of valuation?
I think companies are going to try and do both, right? If you think about M&A, M&A has always been about acquiring products and capabilities, but also about acquiring talent. There have been lots of merger of equals that have been done because it addressed a succession issue. Sometimes people acquire companies because there's a human capital capability that would take them too long to build on their own. So I think that this phenomenon is going to continue, but it can continue in parallel with the merger market. It can continue alongside a very healthy merger market. And I think we're going to see more of that.
It took me a second to get that. Acquisition hires. You're combining those words. I wonder about the deregulation that we were promised, and specifically in terms of like the FTC, right? Are we getting that? Because it drove so much optimism for M&A at the beginning of the year. Obviously, April 2nd brought us back down again, but now it looks like that could be a real tailwind.
So I think that there is a sense in the C-suite and there's a sense in the market that there is a more solution-oriented mindset amongst the regulators today. And so that opens up lots of different possibilities because you could have a merger that is more scrutinized, but if you can find a way to bridge a gap and send it and get it approved, that's a pathway. And I don't think that we had that before. Part of, I think, also what we're looking at is there's a tremendous amount of volatility. We talk about the merger market and the recovery, but the deals that we're announcing today were being worked on 3 months ago, 5 months ago, and we've been doing that through an enormous period of volatility. Think about where we were in January and what the forward outlook was. Think about where we were in April and think about where we are now with Q2 earnings. I think it's been a very interesting journey and a very topsy-turvy journey, but throughout that, we've been able to get deals done and announced and agreed upon.
You've been very close to the market for activism also. What role are activist investors playing in this market? And you could argue hedge funds more broadly or active managers. It seems like investors are certainly wanting more of a say in corporate management. How is it playing out?
Yeah, so you're absolutely right, by the way. Activists, in our view, are just an accelerant for transaction activity and specifically M&A activity. If you think about all of these activism campaigns out there, fully a third of them have some kind of an M&A component to it. I think as the M&A market continues to recover, you could see that go up to even 50%. The activists are going to push companies to do more M&A. They've already been pushing companies to examine their portfolio and look at whether or not businesses need to be divested, whether companies need to be simplified, and then whether or not capital needs to be returned. I think companies are sitting on very healthy balance sheets, and the activists are going to play a role in all of those things. M&A, continuing to look at the portfolio, continue forcing companies to look at the portfolio, and to return capital more aggressively.
Very cool to get some time with you. Really appreciate you joining us. Hope you come back to Open Interest. Avi Mehrotra there from Goldman Sachs. Going to check on what's going on in these markets because there's been so much going on under the surface, but at the index level, not much at all. We pull up those indexes. I'll tell you
I'm
what they're
looking
doing.
on my screen. I'll verbal it. We're at near session lows now. The S&P 500 is down almost it's headed towards 0.4%.
Yeah, actually, there is now some real movement, and maybe it was the ISM number that pushed us down a little, off 1/3 of 1% now, almost to 6,300 on the S&P. In terms of the individual stocks moving at this hour, let's get over to cross-asset reporter Isabel Lee. She joins us for a rundown of some of the earnings results. Isabel?
Hey, Matt, we're first looking at Vertex Pharmaceuticals. So the stock is down after an experimental pain drug failed to benefit patients after a surgery. Of the FDA saying that they don't really see a path forward for the widespread use of this pill to treat chronic conditions. So RBC Capital Markets said that the setback and the mid-stage failure should cause a rethink of the risk profile for the pain franchise. You see shares there down by almost 20%. Up next, we're looking at Hims and Hers Health. So shares are flat after the company missed revenue estimates. So the shares are actually now down by 4%. So the company recorded sales below average estimates, but it did reaffirm its full-year revenue guidance. So Citi said this is a difficult quarter for Hims. Morgan Stanley said investors in Hims should be patient. So Hims has really gotten the boost from selling cheaper versions of its popular weight loss drugs, but that business has since been in peril. And lastly, we're looking at Molson Coors. So this also is a stock that's edging in the green. It's 0.5% higher. The company lowered its full-year guidance for the second quarter in the row, but yet you see a pop there. The company cited continued pressure from a weak consumer, falling U.S. market share, and rising costs tied to aluminum tariffs. So the company now expects underlying EPS to fall as much as 10%, and that's compared to an earlier forecast of growth. And lastly, beer sales are down again, Matt.
Beer sales are down again.
No one's drinking, maybe.
Well, I mean, maybe because they're Canadian, I don't know what the problem is. Or maybe people are drinking more liquor or smoking more weed. That's probably what it is.
Maybe.
Isabel Lee, thanks very much. Isabel Lee from the Cross Asset team talking to us about some of the individual movers. Coming up, Marriott books an earnings beat but issues a disappointing outlook. We'll analyze the numbers next. This is Open Interest. Let's turn now to the travel and leisure sector. Marriott, and business sector. Marriott posting an earnings beat thanks to international demand, but shares are dropping as the hotel company trims its outlook, right now down 1.3% in a down market. For more, we're joined by TD Cowen analyst Kevin Kopelman. He has a buy rating on Marriott with a price target of $300, and I'd love to get your take on leisure versus business. I mean, why are people going to Marriott these days? Is it more one than the other?
Thanks for having me on. Certainly, when you look at Q2 results, leisure was the standout. So leisure outperforming business travel. Just taking a step back here, we think there are reasons to be optimistic after Marriott's print. Certainly, the RevPAR guide was a little bit lower than we expected, but when you dig in, they said Q3 is going to be a little bit slower, but they're actually expecting Q4 acceleration, and they really outlined very specific calendar changes driving that Q3 versus Q4 outlook. Moreover, to your question on leisure, they said the leisure demand has been solid, and they said it's not accelerating, but it was solid in Q2, up 3%, and they said it's basically trending solid quarter to date. And there's another thing is when you're thinking about Marriott, you have to look at their unit growth. And once again, they had a strong pipeline quarter. So they reiterated their full year unit growth guide. It's going to be up about 4.5%. The pipeline's up to 590,000 rooms. So you have a 1/3 growth in your total system size already baked in there with signed contracts.
Hey, Kevin, I'm really curious for clues during this earnings season of a K-shaped recovery here. This idea that the luxury segment, which you're seeing in the U.S. and Canada at Marriott, staying strong, but other segments maybe not as strong. How are you thinking about this dynamic? And is it meaning that companies like Marriott need to be shifting to clients that are more and more wealthy?
Well, travel in general is focused on the higher income household. When you think about Marriott, 1.7 million rooms globally, they have rooms in hotels that cater to all segments of the market. They're not going to be making quick shifts to one way or another way. They're very established. If you're talking about how do higher income trends look versus lower income, certainly we've seen the luxury segment of hotels performing the best. What we heard out of Marriott was it sounds like that continues to be the trend. I don't think we've seen a big change in recent months in how those are performing. So the luxury hotels continue to do the best, whereas more economy mid-scale hotels continue to be under a little bit of pressure.
What's cross-border travel look like, Kevin? You know, so much talk about Canadians don't want to come here. It looked like maybe Europeans wouldn't want to come here, but the dollar was too weak to avoid. How's that working out?
Inbound travel is under pressure. This is something we've dug into. We estimate that the disparity between inbound travel to the U.S. being weak, whereas outbound travel continues to grow, has pressured U.S.-based hotel results by, we estimate, about 1.5% year over year throughout the year. So as of right now, not a big change in that. There continues to be a big appetite for U.S. Consumers traveling abroad and international travel. We think growth in cruise is also related to that. And we continue to see weakness on inbound. And of course, we're waiting for the latest numbers there. The nice thing with Marriott is they have a global portfolio, so they're able to capture Marriott customers all around the world, even when they're traveling not necessarily to the United States.
Hey, Kevin, I'm really curious about how consumers are behaving right now. A lot of people are watching for any weaknesses. Generally, they seem to be holding up. But who benefits if the consumer holds up? Is it evenly distributed, or are you seeing consumers flock to certain types of travel?
Well, like we were saying, these very large hotel and travel companies like Marriott have a broad exposure. Right now, leisure trends are relatively stable in the third quarter. A little bit more volatility in the business travel trends. When we're thinking about Marriott, though, really looking out multi-year, you're talking about a company that's gaining share in good times and bad times through their unit growth. The main reason is they're able to offer hotel investors, people who are opening up new hotels, a safer and more profitable investment in hotel through Marriott brands. And it also goes for Hilton for sure.
Kevin, we thank you for joining us today. That is TD Cowen analyst Kevin Kopelman reading the tea leaves of the travel sector here as we see Marriott dragging the hotel industry lower on the day. But coming up, something is going higher. Those are bonuses. A boost is expected across Wall Street. We're going to tell you exactly who's going to be making that money next. This is Open Interest. And it's time now for the Wall Street Beat. Bonuses are set to rise across most of the sectors of the finance industry as the market rebounds. Bloomberg finance reporter Catherine Doherty has all the details. And I've got to say, something that I find fun in the data that you collected here was that it's the debt bankers. It's not the typical stars that are actually going to be getting the biggest increases here.
That's right. Debt underwriting outperforming equity underwriting.
I thought that was cool, too.
Yes.
You know, that's really telling because we're not seeing the IPOs. Yes, we've had a hot one like Figma, or a couple of them. There was the internet thing. Circle, right? But for the most part, you're not seeing that, and people are going out to get the bond market.
You're not seeing it yet. It will start to come through. So this expectation that we're reading through, this report that comes out, Johnson Associates, they're updating. And 3 months ago, when they were updating based on the first quarter, we saw actually most bonus pools expected to be down across the financial industry. That has reversed for almost everyone across the board. There's still some parts of finance that are going to be either flat to slightly down. You mentioned equity underwriting. That is one of those sectors that hasn't seen the same rebound that we have seen come through with debt underwriting.
Years young.
The year is young, and we will also start to see some of the green shoots that all of the investment bankers were talking about at the beginning or expecting to come through of the year. We're actually starting to see a pickup in IPOs, but that might take months to come and actually bleed into 2026. So all of this activity that is now starting to peek through, it's actually a big question mark of whether or not that's going to translate into bonuses for 2025 specifically.
It's been an incredibly volatile year, right? The S&P was down to 5,000. It was up to 6,400. The 10-year was down to 399. It's been up at 480. That kind of volatility makes me think traders are just cashing in here.
It is a good thing for the traders on Wall Street. Equity trading has seen records in the second quarter. That is translating through to compensation. Debt is not quite as strong, but it's also not weak. We're seeing double-digit increase that are projected for bonuses towards the end of the year. And if that even continues further, you might see, I mean, right now, equity traders are projected to get as much as a 30% bump. That's the highest across any of the financial industry that we have seen. The question becomes, does that volatility, does the momentum that we've seen through the first half of the year continue through the second half?
Now, all of these are reasons that you see, for example, I want to pull up here Goldman stock versus Apollo's this year. I think this is stunning. You're seeing Goldman up, getting closer and closer to 30%. Wow. You see Apollo down almost 15%. I mean, I guess gained some back today, more than 10% still lower on the year. The fact that these debt underwriters are able to take back share from the banks and private credit is actually worried about this, speak through that dynamic a little bit, because there's this push-pull. 1 minute, people are worried that private credit is going to eat the banking industry's lunch, and now it seems to be reversing a little bit.
Yes, and we also have seen the partnerships between the banks and the private credit industry. So this is not as much of a or and, it's an or and because of that. And you see this constant shift that every day we're waking up and hearing about either new deals that are coming through or some more of these partnerships that I expect will continue. And also, this is a new administration, it's lighter regulation, so the big banks are going to start to accept more of the deals that were potentially getting pushed to the private industry before this.
Lighter regulation, but more public criticism?
These bankers always get criticized publicly, right?
By Trump?
I mean, 1 minute they're pulled up on Capitol Hill when the whole dumb money, meme stock thing happened, and all of the Democrats are angry because they're doing business with oil producers and gun makers, right? And now President Trump is threatening to punish financial institutions who don't do business with probably oil producers and gun makers and his followers, right? He complained that he was refused by JP Morgan and Bank America. What's the fallout going to be?
That's right. And the interesting fallout is not just on the banks, but the regulatory body too. Trump and the industry is pointing to the fierce regulation that they have been under that has led to their decision to potentially close down a customer's account because of reputational risk. That is starting to be adjusted, and it will then the question becomes, is it a big enough adjustment that you don't see as many of these bank account closures? Trump today had called out his own experience, which is a very interesting thing. You're not just hearing about the regulators, you're hearing about the president's personal experience that he is speaking to with some of the biggest U.S. banks. So now we're expected to see some of the fallout that you're asking about is going to be on the banks reviewing their own processes, and then also on the regulators reviewing how they're regulating the banks for potentially pushing them to make some of these decisions that they otherwise might not.
Cool. Very cool wrap, Cato.
You should read the story on the Bloomberg terminal, because there you can find the bank's statements in response.
That story and the bonus story has a great breakdown of who's getting paid and who will get less. Catherine Doherty covers the banks for us. Thanks very much, Cato, for joining us. Gonna check on the markets. There we go. S&P down 0.6%. NASDAQ down the same. Session lows here as we sell off some of the gains we made yesterday. Coming up tomorrow, Morgan Stanley's Jim Caron joins us, Mountain CEO Mark Douglas, and Ann Berry of Threadneedle.